Trump tariff shocks have returned with new force in 2025. In this video, we'll examine how fresh duties, imposed under emergency authority, and lingering Trump-era measures are shaping stock market dynamics and offer clear takeaways for today's investors. On April 5, 2025, the administration enacted a 10% tariff on all imports, citing national emergency authority. 4 days later, higher reciprocal tariffs took effect for countries with the largest U.S. trade deficits, marking the most sweeping escalation since 2018. China immediately filed a WTO dispute, while Beijing raised its own duties on U.S. exports. These developments extend duty risks deep into 2025 and beyond, and set the stage for renewed market volatility. Let's take a look at market volatility and sentiment. Equity market volatility spiked after the April announcements, with the VIX jumping over 15% as investors priced in higher input costs and profit margin uncertainty. Domestic funds saw net inflows to manufacturing-heavy ETFs, while international and small-cap funds experienced outflows amid widening trade policy risk premiums. Today's portfolio managers rank tariff uncertainty among their top 3 risk factors, alongside inflation and geopolitical tensions, when evaluating U.S. equity allocations. Let's see how sectoral performance and earnings are looking. U.S. steel and aluminum stocks rallied on expectations of sustained domestic demand, with several firms reporting margin expansions of 300 basis points in the first quarter. Conversely, auto parts manufacturers flagged year-over-year cost increases exceeding 12%, trimming net income and driving share price corrections up to 8%. Clean energy developers warned that higher metal tariffs delayed key projects by 4 to 6 months, pressuring share prices in the short term, but creating longer-term upside for domestic equipment suppliers. Inflation and monetary policy are important to understand as well. Tariff-induced price pressures contributed to a short-term spike in consumer price inflation, pushing headline CPI above 3% in the first quarter of 2025. In response, the Federal Reserve has maintained policy rates at 4.25 to 4.50% under a cruel-to-be-kind framework, holding rates firm to anchor long-term inflation expectations even as near-term spikes persist. Fed Chair Jerome Powell has cautioned that persistent tariffs pose unique stagflation risks, complicating the Fed's dual mandate of stable prices and maximum employment. In 2025, roughly 1 in 5 large U.S. manufacturers reported relocating or diversifying production to domestic sites to sidestep import duty risks. This reshoring wave has fueled strong performance in industrial automation and robotics stocks, as firms invest in technologies that offset higher labor costs and bolster supply chain resilience. At the same time, global networks remain in flux, as companies balance U.S. cost structures against the imperative of avoiding future tariff shocks. Now these are the investor takeaways. First, diversify across geographic and sector exposures to cushion against tariff-driven shocks. Don't concentrate solely in cyclicals or exporters. Second, overweight companies with strong domestic revenue streams and minimal global supply chain complexity as they face lower direct exposure to import duties. Third, consider thematic plays in automation and robotics. Firms enabling reshoring often benefit from increased capital spending in manufacturing. And finally, maintain liquidity buffers or inflation-protected instruments to navigate periods of heightened policy uncertainty and potential price spikes. Now, as an investor, you must be looking for future risks and opportunities. Let's dig deeper. Looking past 2025, the potential for additional tariff hikes, possibly extending to critical minerals such as rare earths, is under active review, posing further risk to commodity-intensive sectors. Conversely, any future tariff rollbacks in trade negotiations could rapidly reprice sectors currently hamstrung by higher import costs, creating sharp upside opportunities. Investors should monitor WTO disputes, Section 232 reviews, and emerging trade frameworks, including US, EU, and Indo-Pacific agreements, as catalysts for the next market rotations. Tariff policy has transcended episodic headlines to become a core driver of equity performance in 2025 and beyond. By understanding the evolving duty landscape, adapting portfolio allocations, and seizing thematic growth trends, investors can convert trade policy uncertainty into strategic opportunity. Thanks for watching. Stay informed, stay agile, and invest with clarity.